While we may not have finished October yet, we did finally hit the finish line on the week, and what a week it was. 2 out of the past 3 weeks. Some big time selling to the tune of 3 and 4 standard deviations, depending upon what you look at. So, how much further down can we go, and where can there be some opportunity to take advantage of such a rare opportunity that we've seen this past few weeks? That's what I break down in tonight's video, so let's go ahead and get started. Today is Friday, October 26, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back. Subscribe to our YouTube channel. Mouse over our Market Scholars logo right here in the bottom right corner of your video. Click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells us you want us to do this again on Monday. Really quick way to tell us you like the video, you got something out of it. Join our daily Market Outlook email list. There's a link that's popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day. And join our Market Outlook community that we created on Facebook. All right, let's take a look at the S&P 500 first. Today with the market forecast indicator, you'll see big time doji pattern here. Big long upper shadow, big long lower shadow after starting down and then finishing down. So we came off of the lows a couple of times today. The second time not as high as the first time, so you end up with the doji, which again, it means that the bulls and the bears were in battle with each other. A lot of bulls coming in this area, as considering how oversold we are. And you can see the near-term line rallied because of the move off the low, the blue line. So the blue line actually still sets up for where the orange lines are, this bullish divergence coming off of this area. We have broken and held below 2,700, as of so far, so far for this week. So now on the weekly chart, you'll get a weekly candle to see if we end up holding the breakdown, because this would be a breakdown to a lower intermediate low point. The last 2 times we've had breaks below the previous intermediate low was the election. Right prior to the election in November 2016, and then Brexit earlier that year. So they came right back initially with those news. So there's no news this go around, no specific event. So we'll see if we likewise come right back off of this. You can see intermediate line strongly bearish. It's below 20, and as I showed you previously on Wednesday, it doesn't stay below 20 for very long. So even when we are in more bearish times, especially here's earlier than year, and then of course in 2015 and 16 I showed you last time too, it doesn't stay down there for very long. The Dow Jones Industrial Average also showing kind of another Harami pattern with the pattern a couple days ago, and a rising near-term line off a higher low point compared to the last one. So that bullish divergence setting up there too. It's the least bearish out of all of them. It's not below that intermediate low point yet like all the rest, so it hasn't dropped as much. You'd expect blue chip stocks to hold their value better. The NASDAQ has really gone down. Another kind of Harami pattern, the body of the candle, and this doji still inside of the body from the previous one. And you can see its intermediate line is forming a divergence still with rising near-term line. And then finally the Russell 2000. It didn't get a cluster today. It actually had a cluster earlier, but again, this convergence of clusters in such a small amount of time. Last time we saw that was March 2009, and that's how significant at the end of a bearish market. So very, very significant to get so many clusters so back to back like this. You can see not getting down below these lows, barely below the lows. It was a lot more, the bounce was a lot more bullish intraday. But again, you can just see, and just to kind of give you an idea, I'm going to take off these here really quick, and I'm going to throw on 1 second. Here we go. You can see the linear regression trend line. So here is you've got multiple. If you take a look at the variable channels, you got 1 standard deviation, you got 2 standard deviations, you've got the 100% level there, and you can see that we are down to, with a really, really high ATR, but we are down to past 2 standard deviations. In fact, You're right about it, the 3 standard deviation level on a 1-year chart. Now, for context here, I mean, again, 3-month chart, you can see very, very low. That's how quick this move is. It's kind of rare to get such a move outside of the 2 standard deviations on a 3-month chart because it has to be quick, right? It's easy just to get this kind of steady move. So that just shows how quick the move has been. Then on the 6-month chart, again, you can see the nice steady trends, and then boom, big move down, it's actually 3 standard deviations. And then finally, the 1-year chart. But if you look at the 5-year chart, just for some context, just how bullish we've been, this move has basically got us down below the midpoint of the chart of where we've been. Now, back here, we had a drop below 2 standard deviations on the 1-year chart in April as well, and that actually set the low point back there. So it kind of gives you an idea here of just how bearish we are on a short term, but not as bearish on the long term. See, if I were to go back 5 years to this week of 319, see, that would be it'd be 319 plus 4 would be the 23rd. So March the 23rd, if I were to go time frame here and go back to March the 23rd of 2018, and then go March the 24th of 2013, so a 5-year chart, right? And we'll put a weekly chart here. So that's what the 5-year chart looked like back then. Again, we were getting a 2 standard deviation drop on the daily chart, but on the weekly chart we were getting right to the midpoint, right around the midpoint. So it kind of shows just how very similar ATR that we're getting right now. You can go back to, this is the current level. So similar moves that we got in April in terms of how you can see, if I were to go to, in fact, let's go back to a daily chart here on the 1-year basis, and you see the daily on the daily chart there, back here on April the 2nd. So if I were to go custom time frame, April the 2nd of this year to April the 3rd of last year. So here's a 1-year daily chart. There's your 2 standard deviation drop that eventually we bounced off of, and how high that ATR to price ratio got. And again, you look at now, and very similar, levels compared to what we had back there. Very similar levels. So this has been a bad 3 weeks, really. But the fact that it was so big and so quick, it's when it's more persistent and pervasive, and you have a chance for it to stay down when it lasts on. When it's a big, fast drop, and that's what linear regression shows us, how fast it was. Then those are, as we saw over here, those are harder to stay down. And easier to come up. Now, whether we come up to a new high, you can see we didn't come up to a new high in the first surge. We actually came down to a lower high. But then we formed this little triangle and broke out of it eventually. Whether we get something like that or not, we are in a better seasonal time of year than we were back here, where the markets are typically bullish heading into November and December into the end of the year. All right, before we take a look at some other charts, I wanted to remind you that, for feedback, for us to see what you think about the videos, we look for 3 clicks that tell us you want us to do the video again on Monday. And those are right here. Click this heart on tonight's tweet. This is on today's Market Outlook blog, on our Market Scholars blog. So click on the heart right here, and that opens up a new window where you can click on like. You also can click right here on number 2. The click here is to click on this image. It will take you to your Facebook page. You can click on tonight's Market Outlook post on Facebook. And then finally, the third one is a click right there. Like I said, a click here tells us you like the video, you want us to do it again on Monday. So one quick way to give us feedback you can do while you're watching the video. All right, back to the charts here, and you can see on the long-term chart, on this weekly chart with the 50 and 200-day moving averages, this is actually a 10 and a 40-week moving average, and their exponential moving average, so kind of a proxy for the 50 and 200-day. You can see that the lowest close that we had This is the lowest close that we have below the 200-day. The first time we've closed below the 200-day moving average since the election, since the week before the election there in 2016. And you can see what happened afterwards. You can also see too, we came close there right in June. So that was the Brexit, and you can see we were much closer. We weren't as bullish when we got those, so much easier. In fact, you usually do get a test of the 200-day moving average after a golden cross here, and so again, the last time we were this far below the 200-day moving average on a relative basis here on a closing week was in early 2016. Again, the last time we were really significantly bearish, especially in the international markets, and again. Even 2015 right there, you can see how, the MACD at that point was at 10. And right now it's at 49. You can see over to the right, it's at 49. So that point we had been grinding for a lot longer. 49 was right there. So once we hit an equivalent level of where we're at right now, we still had about 6-8 weeks of grinding before that decline. So, this kind of a move, you can see on a bull market, when you have the bullish, when you have the golden cross, to get that far of a decline below the 200-day moving average this late in the cycle. See, again, like I said, you usually typically get it. There's a decline. You can't really see it as well because because you can't zoom in. Let's see if I can zoom in. This would be 2012. And then again in 2010, there was a similar drop right there in 2011. The MACD at that point was about at 35. So really, if you can't really see it as well, I'll try to zoom in as best as I can. I have to go over here. So here is that 2011 time frame. Again, we were at about, we were at 18 at that point when the MACD dropped while we were in this bull market. And then here's 2010. We had dropped below, 2012 we had dropped below after a golden cross, right? It retested the 200. So you can see we really don't get these late cycle drops. And here's the first golden cross coming up off of that low point. We had a decline, relatively late cycle. We had a decline in 2010 that prompted, QE2 later that year, and we rallied up off of it that sharp. But we had been flirting with it for multiple weeks before that big drop. So, again, and here's the previous bullish cycle heading into 2007. This kind of a drop, this much below the 200, that fast, from this strong of a bullish long-term momentum, we just don't get very often. And so we'll see if the market responds, again, considering the linear regression, with just as quick of a move to the upside. If we take a look at the 3 green arrow charts, again, you can see the candle there. We got 3 red arrows, everything oversold. But when you break out those lines, the MACD, right now the MACD is as bearish, is actually lower than it was back here on that first initial surge. So that's how far away the 8-day moving average is from the 17. You can see the stochastic setting up for a divergence, a bullish divergence there. If I were to take a look at, let's change that MACD here to the price right now, as far, where are we at relative to the 8-day moving average? And you can see the divergence setting up still there. So that's the 8-day, and if I were to change that current price to the 30-day moving average, again, you can see how low we are and have been a couple days ago relative to where we were here. And again, it's extremely oversold on a lot of these technical indicators. And with volatility as high as it is, we're getting big moves to the upside that we saw yesterday, and even intraday today, as well as big moves to the downside like we saw a couple days ago and also early today. All right, when you take a look at the intraday chart, you can see the lower high and the lower low. But the interesting thing about the low point today is now that produced a 30-point difference between the 4-week high and the low, which means the 4-week range eclipsed the 10% level of the 4-week high point. Again, last time we had that was back in here. Well, actually, not this one. This one here was this decline when we went from that high to that low. That move to that price eclipsed the 10% mark for the 4-week range that held for the next little bit. So and we didn't quite get the same thing that held here. That was still a relatively high level. We went from a high of 280 down to a low of 254, so about 26 points, so a little less than 10%, but that's a big time range for a 4-week move. Now you notice it doesn't necessarily mean that we're going to climb up off of this low, but you can see it's kind of hard to extend that range, and we're not going to. Like, this range isn't going, that high is not going to come down for a few more days. And even then it'll come down to that high point for a couple more days and then that one for a couple more days before we really start tapering down to this 281 level, which itself is a 20-point range. So we're going to have, for another couple of weeks, we're going to have some really wide ranges that in the past have shown on a 10% level, so on apples to apples, a level of kind of extreme width, which bottles up the downside momentum. Doesn't mean that we can't go down, because anything can happen, right? But it slows down that bottom momentum and offers some opportunity for you to do some bargain hunting at these levels. If you take a look at today's range, 64 point, well, that's on SPX. Let's go to SPY. You can see the range today was 8, almost 9 points again. The volume was at 200 million. So if I were to show that here on this chart, you get 200 million, which is well off the charts again. 9 points, well off the charts again. You can see how high these numbers are getting, and they'll stay high because they're an average, right? They'll stay high for a while. This is, these are high levels that, again, when we peak and we roll over, and they can stay high for a while, which means that there's going to be big moves to the upside and the downside before they finally start to grind lower through an upward trend. So we'll keep our eyes definitely on those levels as high as they are. These big extreme moves that are off the charts, they're hard to sustain. The worst kind of moves we get are the ones that are just kind of right, in this area, in this kind of 3 to 4 point range. When you're in this 1 point, when you're above 1, but kind of on the 1 to 1.5, the extreme ranges, they're too big, and like I said, hard to sustain that kind of momentum. You get a few days, we bounce. We get a few more days, extreme, like we've seen before. Do we do a similar move next week that we saw during that week right there that ultimately finished flat? But you can see, it was a couple extreme days that we couldn't sustain to the downside. You can see there's enough sellers that could get us to 265, but couldn't after those first two initial surges to the downside. Of course, volatility surged again to an absolute level of 25, but you notice on a relative basis did not get back up above that 1.115 level. So it's extremely high. It's above 1.05, an opportunity for some selling of volatility. You expect that it would come down and start making its way lower. You can see from a MACD and stochastics on an hourly chart, when you look at it on an absolute basis, the high points on these indicators, this is a high point. It is a higher high compared to this last high point, but you can start to see these indicators aren't forming higher highs and are starting to roll themselves over. Relatively flat, so it's not a clear trend. I mean, we're to the upside, but you notice we're not we're not getting up there and staying up there. We're getting a lot of long upper shadows on volatility. Those appear quite a bit on these big volatile moves because it's hard for volatility to sustain itself. And when you see those long upper shadows, that means there's a good chance for that kind of a move to come out of it. All right, to summarize, there's a lot of indicators that are showing just how extremely bearish this was, and really, in some cases, a little unprecedented, at least in recent history, and a rare opportunity to get into some prices in some stocks that we haven't seen at these prices in a long time, for months, especially if you consider the possibility and the probability of prices bouncing from these areas and finding a low point because, again, of how extreme it is. It's hard for stocks to fall very far from levels like this when these indicators are extremely low. It doesn't mean anything can happen. It's just in the past we haven't seen that. But as high as volatility is, we do expect big moves to the upside and the downside. So there will be big moves as we saw today. So we just can't get too worked up on any big downside moves at these extreme levels. Just like we can't get too worked up on any big bounce moves on an intraday basis or on a 1 day or 2 day basis, because until volatility moderates and starts to grind its way back lower, there's going to be a lot of pain to the upside and to the downside in the short term. Ultimately, until things start to work themselves out at these lows and make their way again. So what do you think? Do you agree with that? Do you disagree with that? Click that link that just popped out in the top right corner of your screen. Then either click on agree or disagree. If you click disagree, scroll down to the bottom and click down and describe what you're seeing. Maybe you see some other charts that suggest there is more selling to the downside, or some other indicators that would suggest we've got some room to go before we find major support. Love to see what you're seeing and share with our market outlook community. All right, now let's talk about what's driving the price action today. And you can see it's a big move up on commodities. You can see long-term bonds started off strong and held their gains. Gold started off positive, held their gains. The dollar did not go higher. It was actually down. It was started the day higher, then fell throughout the day. You can see high yield bonds as well, underperforming treasuries. Gold underperforming crude oil. That's not typical of a risk off, but everything else is, right? You can see U.S. stocks. In fact, U.S. large cap stocks were led the way. In fact, they had a bigger loss than small caps did by the end of the day. You can also see too emerging markets underperforming developed markets, but both those international areas outpacing the U.S., especially the S&P 500. If I were to go over the last 3 months again, you can see the dollar's the only asset class that's up, more than a percent. Right? You have agricultural commodities and other commodities here. They're doing well too. Gold's up 0.84%, and you can see short-term bonds down just a smidge. But everything else, you can see emerging markets, developed markets, they've really suffered the most, more so than the S&P 500, which is still only down about 5.5%. You can see value outpacing, underperforming slightly, growth outpacing value during this decline. Dividend stocks holding up well, real estate stocks, REITs holding up well, preferred stocks. So you can see high yield and investment grade. So we're not getting that broad sell-off in the credit area that would accompany the big selling in the stock areas too. So, and again, another sign, if I were to go back on here and go back to that October the 3rd time frame of when we close right there. So actually we need to go to the 4th. The 4th is the first day of the selling. There we go. There's the first day of the sell-off. And you can see how far we're down now since that October 3rd level, and really what's leading the way down, including crude oil. Now, crude oil has found its low and it's trying to figure something out. And you can see small cap stocks way down, international. I mean, all these equities. So you see high yield has not really followed it down as to the same, even to somewhat, to the same degree, but even a little bit less, right? You would expect a little bit more of a decline if people were selling off these corporate assets as much as possible. On the other end, you can see gold and agricultural commodities benefiting from the safe haven, from the flight to safety during this past couple of weeks. So big declines. Not too surprised that it's having an impact on expectations for the rate hike. So look at this. The odds of a rate hike have really dropped for December, where it was pretty much a done deal that we'd get a rate hike increase in December. Oops. Here we go. Sorry about that. This one. Okay, so you can see that we were above 80%, and look at the big drop that we've had, and then the odds of not getting a rate hike. They're still low, so they're still we're more than likely going to get a rate hike in December. But now the question is, what about the next hike, which is what the market's trying to, usually prices in those two, and you can see the drop for the next hike has dropped down to the same odds as getting no hike in March. So things are really starting to moderate from that front, Again, the markets don't necessarily drop on rate. I mean, the last rate hike cycle, which is a lot more aggressive than this one, they were hiking at every single meeting. The market still rallied during that 2-year rate hike cycle and rallied for another year plus after it ended. And so just because they're raising rates doesn't mean that stocks have to fall, and that's why again I say we're getting a rare opportunity to have stocks as oversold as they are, given the rate hike environment. When they stop raising rates, there's usually a reason. They don't feel like the market can sustain it. If you take a look at the yield curve, if I were to come over here and take a look at the yield curve, as long as that yield curve is not inverted, and you can see it, hasn't quite got there yet. If I look at a daily chart of the yield curve, we never did get to that inversion, and we've actually been kind of slowly grinding higher after the breakout. So the long term, these long-term yields flatten out because the economy stops pricing in growth expectations, and these keep going. The short term keeps going to get up to those levels as the Fed raises interest rates. So, if growth expectations stay strong and these long-term yields rally, and the Fed stops raising rates, then you'll have a rising yield curve, which again normally rises because the Fed starts to lower interest rates. In this case, would be rising because the Fed has stopped raising interest rates, so the short-term yields stop rising themselves. You take a look at gold, and you can see the doji that it's having here. A little bit of a flight to safety move after the breakout a couple of weeks ago, but not really gaining some traction here on the move higher. And then on the other end of the spectrum, you can see, or commodity spectrum, you can see crude oil pulling back, but also not dropping below its 200-day moving average either. Remember, this is typically bullish in late cycle moves, and gold too tends to make a run. You can see if I were to go back, let's go back a little bit longer in time here. Remember, the Fed raised rates from 04 to the middle of 06. And you can see what gold did, especially towards the end of that rate hike cycle right here. That's when they stopped raising rates. Then they kind of settled down. But in the late end of the cycle and after the stock market peaked, you can see what happens. Like there was that big increase in price, the big increase in price for crude oil as well, and that late cycle peak in commodities, which typically lags stocks. And so we haven't really got that big jump in commodity prices that accompanies big hike in inflation expectations. If I were to take a look at inflation expectations here, here we go. You can see the inflation expectations have really been falling since that October the 3rd period, and we had a little bit of a jump, but now are starting to head back down towards 2.2, and we did not get up to new highs here this fall compared to where we got over here in February, when we had that big jump in volatility early in the year with the rise in interest rates. You can see how high inflation expectations rose with that tax reform bill passing. And again, this was blamed. This current bout of volatility was partly blamed on this jump in yields, a breakout in yields. But remember, it was a breakout in long-term yields, not short-term yields, which are impacted by inflation expectations, which obviously are impacted by interest rate hike expectations, subsequently followed by interest rate hike expectations. We did not get a new jump to new highs in inflation. And so now the Fed has, you can see why the odds of a rate hike even in December are falling, not to still at high levels, but you can see how, the markets, at least the inflation expectations, are telling the markets that, hey, this jump in interest rates is actually more of an economic picture more so than an inflation picture, and that can give the Fed pause in their rate hike cycle to say, if we're not jumping up to new highs, and if we come back down and test some of these lows again, then we may not need to continue to raise interest rates at the same level. In fact, you can see if you go back to the end of 2015, this is back here. So that's the end. That's the beginning. There's the end of 2015. that was when they raised interest rates for the first time. They had that one rate hike, it was the end of 2015. They had the first rate hike, and then they had again the next rate hike. So the inflation levels was right about 1.8%. The next rate hike in December of 16, we got another rate hike. You can see we were at 2.1%. So we haven't really, the inflation expectations, according to this particular indicator, has not increased from the time that we got our second rate hike at the end of 2016. And of course, you started to get more of a regular pattern of rate hikes. You had 3 of them in 2017, and then of course 3 so far going into December number 4 in 2018. You can see, okay, well there was a jump from 1.8 to where we are now, but we're not continuing to go higher. So this kind of shows, the Fed's got a pretty level take there on inflation, and so this worry in the market that rates are taking off, that we're going to get this inverted yield curve because of extremely high inflation expectations, is not playing out in the actual chart, in the indicators themselves. Again, rare opportunity to take advantage of this, considering how big the sell-off has been because of those fears. From a sector rotation standpoint, you actually did get a little bit of a positive sign here, in that you can see the biggest winners today you did not have staples, utilities, and real estate up. In fact, you had materials, energy, and industrials higher. Healthcare, safe haven, but also a relative performer, has been doing really well. Only a small loss for the last 3 months. But industrials, energy, and materials, or the other way around, those have been your biggest losers. So they really bounced up the most today. Discretionary, technology, consumer services down. That's what dragged the market down. But to see these areas, you can see those areas are kind of just matching the market. Those numbers are down, obviously not down as much as some of these other really sold off areas. And so it's a sign, a little bit of an overbought. The market's trying. In fact, here materials and energy were actually up during one brief period today, and finish with a 0.5% loss, 0.75% loss. So, if you were to look at it this way, there's your materials and your energy, and then industrials there. So a very positive sign from that perspective, showing that the market's trying to find some value in its really beaten up areas that are beaten up the most. You would think that these areas, technology and discretionary, have been beaten up the most, but the reality is it's those areas. And if I were to go back to October the 4th and when the selling started, so there's your 9% decline in the S&P, there's your discretionary, technology and consumer services kind of matching the market down, there's your energy, materials, and industrials. There's your biggest losers. And so you can see the market, did not continue to buy these today, these safe haven areas. They bought these, which means they're looking for value. They're looking to find this low point right now, and we'll see what happens. See if the market does indeed, with that basket of negative earnings that impacted these areas, technology and communication services. And now that that's behind, and discretionary with Amazon, now that that's behind us, and those stocks are now at some really very attractive levels in terms of price, if that helps the market also give them opportunities for value in some really beaten up areas, that helps it set that low point there. One area of the market that's really was beaten up during this rise in interest rates was the real estate sector, and this is Pulte Homes, Pulte Group, really beaten up. But look at this, a weekly chart, how far down below we got, how far the 50-day got below the 200. It's farther than what we've seen in the last 5 years. If I go back even further, you can see it even further back than this whole recovery. That's how bearish we were. Just sitting at 35 earlier this year, when you had to remember that initial surge of inflation, of interest rate hikes. Now remember, we've got another surge. We had that surge of inflation expectations brought us down to 200-day moving average. We had another surge of interest rate hike or interest rate expectations with the breakout, but this one didn't include the spike in inflation expectations. So a big time drop down to some old high points here, with a big bullish engulfing pattern this week. If you take a look at its market forecast chart here, you can see the recovery, the bounce off of lots of clusters on the daily chart. You can see all the clusters that we had for consecutive weeks in the weekly chart. The short-term sentiment finally getting up to a higher level than we've seen for a while. Go back to that daily chart there. You can see the intermediate postures turning bullish, not above the moving average yet. There could be some short-term resistance there, but finally getting up above the 20 level on the intermediate line. You take a look at some of these other technical indicators, the Bollinger Bands. Right, we've been in the lower half of the Bollinger Bands for so long, finally getting above that line. Now we did that back here as well in August, before those continuing rate hike odds and interest rate jump pushed this sector down. But you can see how closing above a couple of weeks highs here, coming up off these levels. You look at the DMI, which has been so strongly bearish. Crossing now above the 20 level, you're getting a bullish cross on the DMI with the ADX really high. So change in trend with a lot of volume here, a change in trend. And then finally, the 3 green arrow chart here. You can see we got 2 green arrows coming up on that third one on the moving average. If you take a look at the 2-line version of those arrows, you can see up above the 17-day moving average. Still not there above the 30, but above the 17-day MACD and stochastics crossing their moving averages and rising now at strong bullish paces. So, we don't want to be overly aggressively bullish, but if we can sell, a put vertical spread at that 23-21 into December, you can see it's got relatively high odds as it is. It puts your break even at below these lows, kind of in the middle of this week's big candle. So if we get back in the lower half of this week's range, then you'll, depending upon what kind of loss we're willing to take up to a 54-cent loss on this, considering that's how much we're trying to make. If we stay up above this level here, where you can kind of see a little bit of a breakdown, then boom, right back up on that earnings, then we are able to let time decay do its thing. So just one area of the sector that has been really, really beaten up like others. It's really cheap prices compared to where we were just earlier this year, up at 35, dropping all the way to 20, a $15 drop. It's almost a 50% drop in the price. Again, because of these rising interest rates and how they impact mortgage rates and how they impact the real estate sector in general. So, kind of a quick little move higher in an area similar to, taking advantage of cheap prices, similar to the theme of this opportunity that we might have spread out across multiple sectors. This one already showing us the bounce that you might want to see before you start looking at some of these other stocks with that technical, especially that technical reversal, that engulfing pattern that we see on that weekly chart. All right, well, that wraps us up for tonight, for this week. So now I want to hear from you with that link that popped out there in the top right corner of your screen. Let's comment on in the Market Outlook forums on MarketScholars.com, and let's continue discussion over the weekend about what you think about this market and what you expect to see, and any questions or comments you have on what we talked about here, or any questions or comments on something I didn't cover in the video. Let me know there in those forums. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon down below, and comment on our video. Also remember to follow me on Twitter for more content throughout the day, and join our community on MarketScholars.com, as well as the community we created, the Facebook page we created on Facebook. So that being said, have a great rest of your weekend, everybody, and we'll see you all next time.